There are a lot of confusing things going on economically right now. We have all this news about inflation, unemployment numbers, supply chain issues, and all this stuff. It might seem abstract to real estate investors, but the things that happen in the broader macroeconomic climate have really important implications for real estate investors. So today I'm going to walk through these three really important indicators. We have inflation, unemployment, and retail sales, and we're going to review not only where they are and where they might be going over the next couple of months, but how it impacts you, the investor, and what you should do about it. What's going on, everyone? This is Dave Meyer. I'm the Vice President of Data and Analytics at BiggerPockets, and I'm super eager to jump into this topic today because there is a lot to cover. So please make sure to give us a thumbs up and let's just get straight to it. We're going to start with the topic that is top of mind for pretty much every type of investor right now, which is inflation. Inflation, if you haven't heard, is a pretty big deal right now because it's higher than it's been in about a decade. But some seemingly good news has been emerging. But first, before we get into the news, let me just do a quick explainer if you're not familiar with inflation. It basically means that the costs of goods and services are increasing, and people hate this because it essentially means they're losing money. As an example, let's say you have $10 and that $10 can buy you your favorite sandwich. Maybe it's an Italian sandwich or a turkey club or a Cubano, who knows? When inflation hits and the sandwich that you love and cherish now costs $15, that really sucks. You used to have $10 and you could buy a whole sandwich. And now with $10, you can only buy 2/3 of a sandwich. And this is exactly why everyone hates inflation. Since January, inflation has been going up, and there are a few reasons for this, but the major ones are the 3 stimulus packages over the last 18 months that have dramatically increased the monetary supply in the US economy, which can have inflationary effects. The other thing is supply chain issues from COVID-19 that is suppressing supply in key industries like semiconductors, cars, and even paper. Yes, even lowly paper is hard to come by right now. But recent data suggests that the rapid rise in inflation that we've been seeing could be slowing down. The core inflation number, which excludes volatile prices like food and energy, was up only 1% month over month in August. And the broader inflation number that does include food and energy was up just 0.3%. And while it's still up, which absolutely no one wants to see, it's the lowest month over month inflation number since January. To put this in perspective, in June, it was 0.9% month over month growth, which is 3 times greater than it was in August. And the biggest decrease in August came from travel and used cars, if you're curious. Now, it's really tough to say what is going to happen from here because things like travel, which is probably being suppressed by a resurgence of COVID cases, I can imagine prices recovering over the next several months for travel. But on the other hand, supply chain issues seem to be resolving themselves, albeit slowly, and that could offset rising prices in some industries. So this is going to be something to watch. If inflation spikes back up, you can expect to see 2 major things. First, big volatility in the stock market because inflation threatens returns and spooks equity investors all the time. Second, as related to real estate investing, the Fed will face pressure to raise interest rates. And raising interest rates is generally considered a great way to fight inflation, so they could do that. And if they do that, it could send mortgage rates higher and subsequently could cool off the housing market. But if inflation continues to taper off, you can expect that the Fed's going to keep rates low for another year or so, and the housing market will probably continue growing pretty rapidly. But regardless of what happens, remember that rental property investing is one of, if not the single best ways to protect yourself against inflation. There are a couple reasons for this. First, home prices tend to keep pace with inflation. When prices go up across the whole economy, house prices tend to at least keep pace, if not exceed inflation. Second, rents tend to keep pace with inflation. So while your biggest expense, your mortgage, stays flat, your income can actually grow and keep pace with inflation. And this is probably, at least in my mind, it is the greatest way to hedge inflation. You lock in your big expenses and your income continues to grow. Lastly, real estate investing just generally has a very high floor. Like, you can't do that badly. Just by paying down your mortgages, you can earn a 5 to 6% return on interest, which should keep pace with inflation all by yourself. So unless you have to sell at a loss, you can still continue to generate solid returns even while inflation is happening. So just remember that while inflation sucks for everyone, it sucks less for rental property investors. And if inflation stays high, mortgage rates will rise. So locking in good rates now could be a good idea. Okay, let's move on to our second economic indicator, which is unemployment. Unemployment continues to be very strange and confusing phenomenon right now. So let's just get into some of the details. The big news this month is that hiring slowed down dramatically in August. Non-farm payroll rose by only about 235,000 jobs. And that may sound like a lot of jobs, and I guess in some climates it is, but it's down so much from July, which has been revised to 1 million jobs. So only a quarter of the jobs were added in August that were added in July. So this is a huge drop, and the preliminary thinking is that this is because of the Delta variant. With cases rising, people are going out less, maybe job seekers are less eager to go into work, and some sectors like food, beverage, and travel are probably just not hiring as quickly as they were. So this is a big step backwards, but there is some good news. The Labor Department's household employment survey showed that the unemployment rate still dropped from August from 5.4% to 5.2%, which is the lowest the unemployment rate has been since March of 2020. So although we didn't add as many jobs as we might have hoped, the unemployment rate is still falling. In further good news, wage growth was up 0.6% month over month, which brings the annualized wage growth up to 4.3%, which is a lot higher than it has been in recent years. Listen, it is not enough to keep pace with current inflation numbers, but in August, at least wage growth grew faster than inflation. And that is a really good trend. So let's hope that that trend continues. That would be a really big boost to the entire economy. And specifically for rental property investors who need to raise rents to offset inflation costs, wage growth is one of the biggest predictors of the ability to raise rent. What's crazy to me is that at the end of August, there were still 10.1 million job openings in the US. So while unemployment is higher than anyone wants it to be, there are certainly enough jobs out there that people who want employment should be able to find work. In September, just a few weeks ago, the federal government's additional unemployment insurance benefits expired. And it's been long speculated that these benefits expiring would be the catalyst for many people who have been out of work for a long time to get back into the labor force. There have been numerous studies that show that many people are making more income from unemployment than their previous job. So it'll be interesting to see what happens in the labor market in September now that these additional benefits have expired. For real estate investors, the more employment, the better. It is the foundation of a strong economy, which in turn supports financially stable tenants and wage growth, which should help investors offset the impacts of inflation. Personally, I honestly just think it's a matter of time. With all those open job positions, I think unemployment's probably going to get back to 3 to 4%, which is where it should be in the next 6 months. Lastly, let's quickly talk about retail sales. And this isn't really as relevant to real estate investors, but it is a good indicator for consumer sentiment and spending. In August, retail spending rose 0.7%, which is a fairly significant increase. So while the Delta variant does appear to have negatively impacted job numbers in August, it doesn't seem to be impacting consumer spending. There were big gains in grocery stores, big box stores, furniture sales, and a couple other major sectors. And while this metric, again, isn't directly related to real estate investing in any way, retail spending makes up an enormous portion of the economy, and seeing it rise so significantly in August is a good sign that the US economy as a whole is poised for growth for the foreseeable future. All right, that is what we have this week. Inflation is going up, but we might see it peak soon. Job numbers in August were just absolutely dismal, but there's hope on the horizon, and retail spending is indicating that the US economy is poised to continue growing at a solid clip for the foreseeable future. Thank you all so much for watching. I hope that you enjoyed this video. And if you did, make sure to give us a thumbs up and subscribe to the BiggerPockets YouTube channel. I'm Dave Meyer, and I will see you all next week.